In this video, uh, we want to explore the evolution, right? What has happened since the beginning of capital asset pricing model in the late to early 60s? What has happened to that model over time? So the capital asset pricing model assumes the market portfolio includes all stocks, all bonds, real estate, private businesses, human capital, collectibles. So in reality, that market doesn't exist. We cannot calculate that model. So we use what's referred to as a proxy. So we're going to use the S&P 500 most of the time, or we can use some global equity indexes. What this does is create some benchmark error, right? We can never really test the theory because we can't measure one of the variables. So if your benchmark is wrong, your beta could be wrong, your required rate of return could be wrong, your performance evaluation could be wrong. So this is a significant practical issue with using the capital asset pricing model. So what have we been able to find over time? An alternative theory emerged called the arbitrage pricing theory. It asks a more straightforward question. What common forces drive returns across many assets? The key differences from the CAPM is that CAPM is one factor, APT, many factors. There's no requirement for a market portfolio in arbitrage pricing theory. There are fewer behavioral assumptions. In arbitrage pricing theory, relies on the concepts of arbitrage, not investor optimization. So it takes some of the behavior aspects out of investing. So the formula has the same basic structure, though. There are a set of factors that explain the risk elements. That is, those things that impact returns. APT says that we expect that expected returns depend on exposure to multiple systematic factors. There is a risk premium for each factor. So each factor has a price. Each asset has a sensitivity. The expected return is the sum of those exposures. So how we would ultimately calculate this is we have a company, right? Here's company A. Here is their APT model. The lambdas here are the factors, whatever they may be. And we have weights that tell us, or prices that tell us the sensitivity of stock A to those factors. So if lambda 1 was 4 and lambda 2 was 5, we would plug that in and we would end up with an estimated return. Very similar to the capital asset pricing model. The challenge that we have are these lambdas, right? What are they? So the Roll-Ross study in 1980 was really the study that uh, was there to contradict um, capital asset pricing model? Is there to say it wasn't the right model? But basically, it takes two steps. We need to estimate the returns and ask, obviously, if they adequately address pricing. And what we have found is basically there's just inconclusive evidence, right? We're going to estimate returns and the factor coefficients, and we use these estimates to test returns. And again, the authors, Roland Ross, have basically generally support APT, but they also say that their tests were not exactly conclusive. So, what does the evidence support? It says that multiple factors matter. The capital asset pricing model is just too simple, but it has weaknesses. APT has weaknesses. It doesn't tell us which factors to use. So that gap, that not knowing what the factors are, is filled by what we refer to as multi-factor models. So neither CAPM nor APT appear to explain anomalies, though, right? Both of these models, there is just nothing out there that tells us or tries to explain some of the abnormalities we actually see in the market, as in the small firm effect, right? It says that small companies tend to outperform large companies, right? So Reiningham did some research on APT tests. They said that their results, they were inconsistent with the APT. So APT doesn't do the job. Chen supported the APT model over the CAPM. It said that it's better than the CAPM. What about the January effect? These two researchers, Goldskin and Goldskin, basically said APT model wasn't any better than CAPM. These researchers said the effect wasn't captured by the model, but they still said CAPM was worse than APT. So again, we have mixed results across the board as to which model is better with these very prevalent anomalies that are in the marketplace. So they're there, and we just can't explain why they're there. So let's move on to our multi-factor models then. So what do they look like? They take on the APT framework and they make it a little bit more usable. So instead of abstract factors, we're going to use things like market indexes, firm characteristics, and macroeconomic variables. This is where theory meets practice. So we have a series. It looks somewhat like CAPM. If you kind of ignored these last pieces here, that's the capital asset pricing model. That's the security market line. So again, it looks a lot like it, except now we're using more variables to try to explain the market risk of the company. So Chen, Roll, and Ross came up with this multi-factor model, and this model used, as you see, many different variables. They used the growth rate in industrial production. That's a macroeconomic number. They used inflation. They used the difference between actual and expected levels of inflation. They used unanticipated changes in the bond credit spread between BAA yields and the risk-free return. So again, these are macroeconomic variables used to try to explain the risk, the market risk that stocks are impacted by. Pham and French developed a model, and this model looked at more microeconomic terms. So they began looking at, here is our CAPM model, and then they looked at SMB. Here is the return to a portfolio of small cap stocks minus the return to a portfolio of large cap stocks. So they found the returns of something, let's say it's the small cap index and a large cap index. And then they found the difference. And then that is the variable that they use to try to show the relationship between risk and return. They also looked at the concept of book to market value ratios, right? So this is the book value of debt related to the market value of equity. Excuse me, that's sorry. It's the book value of equity compared to the market value of equity, right? We would expect if companies are performing very well, the market value of equity should be much more than book value. So this gives us a reference to companies that are growing, building, etc. That certainly could have an influence on returns. They also incorporated some other variables, right? So the model is getting very complicated now. However, once you have the data, the complication is actually gone because the formula itself is simple. So they also added some company quality variables. So these aren't even really numerical of nature, but they just look at a relationship, right? These are the look at quality numbers. So what do we find out in the end, right? In practice, professionals want to choose factors. They want to estimate them. They want to look at sensitivities. So the framework, the APT and the multi-factor framework, looks at risk models, portfolio attribution. I mean, we use this for everything. So it's very important to try to get this right. So chapter 7 delivers some critical insights, right? First of all, risk that can be diversified is not rewarded. Beta measures systematic risk. CAPM, clean benchmark, but it's not perfect. Multi-factor models dominate modern practice, right? This is what we're using today. Expected returns are fundamentally tied to risk. From here, where do we go? Now we're able to analyze portfolio performance. We're able to understand the differences between active and passive management, how those exist, and we're able to create some factor-based investment strategies. So we can take our prediction model beyond that of just understanding the market to understanding these other macroeconomic and microeconomic factors that influence the returns of companies. So, in a nutshell, I mean, that is really a very short 2 videos on the pricing models. Um, we could very easily have expanded this into 2 or 3 chapters, but thankfully we won't do that. So look forward to seeing you in the next video. Take care.